Get more on what we can expect from banks when they report tomorrow. Chris Marinac is Director of Research at Janney Montgomery Scott. Chris, great to have you with us. You say it's all about J.P. Morgan and what it says. It'll set the tone for earnings season.
Absolutely. I mean, Jamie is the leader of our industry, and I think his talking tough about both the balance sheet at J.P. Morgan being a fortress, capital growth, as well as sort of being careful about credit going forward. I don't expect credit issues to be a problem in first quarter. I think it's the second and third quarter outlook that's very uncertain. And I think Jamie's going to talk about the need to build reserves, the need to be careful. The good news is he has the earnings, and so do all the other banks, to handle any increase of both credit losses as well as the reserve. I look at this very similar to what we had in the second quarter of 2020 when COVID first started. Banks built reserves very aggressively for 2 quarters, and then they backed off. Mm-hmm.
You cover a swath of banks, not just money centers, but also regional banks, Chris. And I'm wondering, what is your assumptions in terms of the economic outlook? Are you assuming recession? Because you say that there are no-touch banks out there. So what is that backdrop that you're assuming?
Sure. So I think if we have a recession, it's going to be mild, similar to 2001. I think that if it happens, it's not happening right this minute. I think it could be later this year. But more importantly, the loan growth for the banks was very limited to begin with. So we enter in this quarter with a falling cost of funds, improved credit marks and interest rate marks that is going to enhance tangible book value. And I think most of these companies have a relatively limited loss set up for the rest of the year. What it could be surprising is how banks address the unknowns of what happens next year with the trade war, the tariffs, et cetera. So I think reserve building is going to change estimates. But the market has set about a 20% haircut to bank stocks, implying that estimates come down 20%, which I think is way too high. I think 8 to 10% is more appropriate, primarily to counter for slower loan growth and also some build on the reserve side.
Chris, it's Karen. So J.P. Morgan's come down an awful lot from the high of just about 280, almost 20% or so. Do you think it is better here now with what's happened in the world, the uncertainty in the economy, versus at 280 with animal spirits and feeling flush and, a lot of good things to think about that haven't materialized, M&A and that sort of thing?
Well, if you think of it from a price to earnings standpoint, it's better here. I also think that it's better on a price to book. I mean, not that Morgan gets traded on a book basis, but they're going to generate a fair amount of capital this year. So being able to come in at a lower price is just a better buy. I think the animal spirits can come back. We still have deregulation. We still have the opportunity for the economy to do better beyond this sort of negative spot that we're in. I haven't given up hope that can improve. That's why I look at this as back to 2001 as a better analogy than a 07, 08 environment.
Hey, Chris, it's Chris. When you look at the banks kind of going into this over the course of the last several months, I mean, they were really carrying the flag of leadership for the broader market. They weren't the problem going into this. Do you think that puts them in a decent spot to come out the other side, still kind of retaining the market leadership? Maybe first question. And then just very quick, if you look at the non-banks that may have some credit exposure, Apollo, Carlyle, Blackstone, are you watching those for some message here as well?
Well, yes and yes. I think that the banks can stay a leader because they come out of this quarter with less credit issues than perceived. I think that the outlook for the future is more uncertain than it is bleak. And I also think the bank's capacity to make money in many type of markets is quite good. That gets back to the capital build. That's going to feed buybacks, and buybacks, I think, will create enthusiasm for investors, particularly with J.P. Morgan tomorrow. On the private credit side, I think it's early innings. I think a lot of the private credit has been extending higher leverage at a higher rate. And yes, that will be a problem eventually, but I think it's very early innings. So I don't think you're going to see those disruptions occur. I'm not sure it even happens this year. I look at it as a next year issue, but something that we have to monitor. And obviously the prices are going to take that off of up front, which sort of already has occurred.
Chris, great to see you. Thank you.
Thank you.